Have you ever watched a stock run up, felt smart riding it higher, only to hold just a little too long and suddenly see all your profits vanish before your eyes? That sinking feeling in your stomach, that moment of regret, that's the price we pay for not knowing when to step away from a market move that's exhausted its potential. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the globe. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. You know, I've spent decades studying the markets, and there's one skill that consistently separates the professionals from the amateurs, the winners from the lambs headed to slaughter. It's not about catching the beginning of trends, though that's important too. No, the real secret is knowing when that profitable move you've been riding is about to reverse. Has this ever happened to you? You catch a great trend, watch your position grow, feel that surge of confidence as the market confirms your analysis. But then you get greedy. You want just a little more, just a few more points. And in that moment of hesitation, the market suddenly turns against you, erasing weeks or even months of patient work. Richard Wyckoff, one of the greatest market operators of all time, understood this painful cycle better than most. A trader who can't step aside at the right time, he once remarked, will give back everything he made on the way up. This wisdom, though simple to understand, is remarkably difficult to implement in real trading conditions. Stay with me until the end of this video series, because what you're about to discover might just transform your approach to the markets forever. Wyckoff believed that the market always leaves footprints, subtle clues that tell us when a trend is weakening before the actual reversal becomes obvious to the crowd. The first and perhaps most critical of these clues is volume. As Wyckoff repeatedly emphasized, prices don't move without money behind them. A healthy, vibrant trend breathes with heavy volume, supporting each new advance. But when you start to see prices climbing with progressively shrinking activity, that's the market whispering its first warning. It's like watching a boxer in the late rounds of a championship fight. The punches might look the same at first glance, same form, same technique, but an experienced eye notices the diminishing power behind them. The fighter is tiring, losing strength. Similarly, a market that's advancing on thinning volume is showing exhaustion that most traders miss completely. What makes this approach so powerful is that it allows you to act before the actual price reversal occurs. While the crowd is still celebrating new highs, you're quietly recognizing the internal weakness developing beneath the surface. This advanced warning system is what allowed Wyckoff to build and protect enormous wealth through multiple market cycles. But volume is just the beginning of the story. There are several other critical signs the market gives us before a major reversal, patterns that repeat with remarkable consistency across decades of market history. And understanding these signals in combination creates an almost unfair advantage. If you've found value in these market insights, hit the subscribe button to join our community of serious traders. I'm dedicated to sharing the timeless principles that most market participants never fully grasp. Now, I want to go even deeper into this topic by revealing what Wyckoff considered one of the most unmistakable signals of an impending reversal, the sudden, sharp break. This pivotal moment in a market's journey often arrives without warning, catching the unprepared trader completely off guard. Imagine watching a stock that's been climbing smoothly for weeks, perhaps months. The advance has been orderly, predictable, almost mechanical in its consistency. Then, seemingly out of nowhere, the stock drops sharply in a single session, often on volume that dwarfs anything seen in recent memory. This isn't just a random fluctuation, it's a revelation about the hidden truth beneath the surface. The fascinating aspect of this phenomenon is how differently professional traders and the public interpret the same event. The crowd, always eager to maintain their positive mindset, dismisses the break as just a healthy correction or profit-taking before the next leg up. They see it as a minor detour on an otherwise unchanged journey. Wyckoff, however, understood the profound transformation this moment represents. As he famously noted, trends end not in a whisper, but in a crack. That sharp break is essentially the first gunshot in a retreat, a clear signal that the dynamics that sustained the uptrend have fundamentally changed. The decision to ignore this warning has been the downfall of countless traders throughout market history. But the market's language is even more nuanced than this. Before that dramatic break occurs, there's often a more subtle phase of hesitation that provides early warnings to the observant eye. This is where the tape, the continuous record of transactions, becomes your most valuable guide to what's really happening behind the scenes. Near the end of a trend, you'll notice a distinctive shift in character. Instead of the steady, confident climbing that characterized earlier phases, there's stalling, backing, and filling, aimless action. The stock appears to want to move higher, but can't seem to muster the energy. It's like watching an athlete who's pushing against their limits. The effort is there, but the impact is diminishing. This hesitation tells you something crucial about the market's internal structure. The big players, the institutions and professionals who drive major price movements have quietly begun to withdraw. They're no longer supporting the market with aggressive buying. Their absence creates a vacuum that becomes increasingly apparent in the stock's behavior. What makes this insight so powerful is that it allows you to detect weakness before most participants even realize something has changed. While others are still focused on headlines and stories, you're observing the actual heartbeat of the market, the rhythmic flow of supply and demand that ultimately determines price. The combination of these signals, diminishing volume, hesitation in the tape, and finally that sharp reversal, creates a roadmap for navigating some of the market's most challenging transitions. It's not about perfect timing or predicting exact tops. It's about recognizing when the probability has shifted against you. If you've experienced these market moments yourself, write, "I've seen the crack," in the comments below. I'd love to know how many of you have witnessed this phenomenon in your own trading journey. Now let's explore one of the most deceptive phenomena in market psychology, the cruel trap that often marks the end of a major move. Just when you think a trend is at its strongest, the market presents what Wyckoff identified as the final desperate rally, sometimes called a blow-off top. This moment represents a profound hidden truth about market dynamics that most traders never fully grasp. Picture this scenario. A stock that's been steadily climbing suddenly accelerates, soaring faster and higher than seemed possible during the entire previous advance. The financial media celebrates this explosive move. Analysts upgrade their targets, and a contagious excitement spreads through the investing community. It's a moment of transformation, but not the kind most participants imagine. What appears to be ultimate strength is actually the market's most elegant deception. This final surge isn't evidence of renewed power. It's the last gasp of a dying trend. The blow-off top serves a specific purpose in the market's natural cycle. It creates the perfect environment for smart money to exit their positions by attracting a flood of late-arriving buyers who fear missing out. The psychological impact is fascinating to observe. The very moment when caution should be at its highest is precisely when most investors abandon it entirely. Their mindset shifts from reasonable analysis to emotional reaction. The fear of missing out overwhelms rational decision-making. This is why Wyckoff emphasized that successful trading isn't just about charts and indicators. It's about understanding the human elements that drive market behavior. Looking deeper into market structure reveals another critical insight that complements this understanding. In every significant market advance, a select handful of stocks lead the charge, the generals who command the broader army. These leaders establish the tone and direction for the entire market, and their behavior provides early warnings that the average investor typically misses. When these market leaders begin to falter, even as the broader indices continue upward, it's as if the market is whispering a secret to those paying attention. The disconnect between weakening leaders and still rising averages creates an invisible divergence, a behind-the-scenes revelation that the foundation is crumbling while the facade remains intact. This principle applies equally to individual stocks and entire markets. A trader who focuses exclusively on broad indices or headline numbers misses the nuanced story being told by the true driving forces. It's like watching only the scoreboard without observing the players on the field. You might know the current score, but you'll have no insight into how the momentum is shifting. The wisdom in Wyckoff's approach lies in training your perception to detect these subtle shifts before they become obvious to everyone else. By the time the average investor recognizes that market leaders are breaking down, the opportunity for a graceful exit has often already passed. The true edge comes from developing the awareness to see these early warning signs when others remain oblivious. What's remarkable is how consistently these patterns repeat across different market eras, from Wyckoff's time to our modern markets. The technology and speed may have changed, but the fundamental human reactions that drive market behavior remain essentially unchanged. If you've noticed this pattern of leaders weakening before the broader market turns, type "leaders show the way" in the comments below. The psychology of market participants offers another profound window into upcoming reversals. Wyckoff's genius was partly in recognizing that human behavior follows predictable patterns, a revelation that can transform your entire approach to market timing. Consider the emotional journey that unfolds during a typical market trend. At the beginning of a significant move, skepticism dominates the landscape. The public remains doubtful, cautious, even dismissive of the emerging opportunity. This widespread hesitation creates the perfect foundation for a sustainable advance, because there's abundant sideline money waiting to enter as the trend develops. Ready to see the markets through Wyckoff's eyes? Subscribe now and gain access to the hidden patterns and distribution concepts that separate professionals from the crowd. As the move progresses and prices climb, a gradual mindset shift occurs. Skepticism gives way to acceptance, then cautious optimism. More participants join the trend, validating the early adopters' decisions and creating a self-reinforcing cycle of buying. The narrative becomes increasingly positive, with experts highlighting all the reasons why the advance makes perfect sense. But the most telling phase, and the one that signals danger, arrives when optimism transforms into absolute certainty. By the end of a major trend, everyone becomes a bull. The euphoria spreads beyond professional circles into everyday conversations. When cab drivers, barbers, and people with no previous market interest start offering stock tips, you're witnessing a powerful warning sign. This widespread optimism might seem like validation, but it actually reveals a hidden truth about market mechanics. If everyone is already invested and bullish, who remains to buy? The pool of potential new buyers has been exhausted. This exhaustion of buying power creates the perfect setup for a reversal, regardless of how positive the narrative remains. What makes this insight so valuable is that it allows you to step outside the emotional current that sweeps most investors along. While others get caught in the euphoria, you can maintain perspective, recognizing that extreme sentiment often precedes dramatic reversals. Equally revealing is how a market's rhythm changes as it approaches exhaustion. Markets, like living organisms, establish patterns, habits that become familiar to observers. During the healthy phase of a trend, a stock might rise decisively, then consolidate briefly in a tight range, then rise again, creating a steady, predictable rhythm that instills confidence. But as the trend ages, these habits begin to break down. The quality of movement undergoes a subtle yet significant transformation. Instead of crisp, energetic advances followed by short, constructive consolidations, you start seeing weaker climbs, followed by longer, more aimless drifts. The tempo slows noticeably, just as a marathoner's pace diminishes in the final miles. This rhythmic deterioration speaks volumes about the internal condition of the market. It's not just that momentum is slowing. It's that the fundamental character of the advance has changed. The once vibrant trend now moves with the labored pace of exhaustion, struggling to maintain the energy that previously carried it higher with ease. Detecting these rhythmic changes requires patience and observation, qualities that separate authentic market analysts from mere trend followers. It's about developing a sensitivity to the market's natural cadence and recognizing when that cadence begins to falter. If you've noticed this shift in market sentiment from skepticism to euphoria in your own trading journey, comment "sentiment cycle recognized" below. I'm curious how many of you have witnessed this psychological pattern unfold. Let's shift our focus to something that separates professional traders from amateurs: the disciplined application of stop losses. Many view stops merely as defensive tools, insurance policies against disaster. But Wyckoff understood their deeper purpose in a trader's evolution. Stop losses aren't just protective mechanisms, they're powerful teachers of discipline that transform how you interact with the market. When placed strategically, stop losses force you to confront reality rather than fantasy. They create a decision framework that removes emotional interference at precisely the moments when emotions are most likely to cloud judgment. This disciplined approach creates a boundary between wishful thinking and market reality. Consider the internal dialogue of a trader watching a position move against them. Without a predetermined stop, the mind creates elaborate narratives. It's just a temporary setback. The fundamentals haven't changed. It always dips before the next leg up. These stories serve one purpose: to justify inaction when action is required. The market doesn't care about your stories. It only responds to supply and demand. The tragic journey of countless traders follows this predictable path. They identify a trend correctly, profit initially, but then surrender those profits when the trend reverses because they couldn't execute the discipline of stepping aside. The simple act of honoring stop losses could have preserved their capital, but pride prevented the necessary action. As Wyckoff observed, many fortunes have evaporated because traders told themselves just a little longer it'll bounce back, when a predetermined stop would have saved them. This principle connects to a profound market truth. Your capital represents your future opportunity. Wyckoff used a powerful military metaphor to illustrate this concept. Your capital is your army. Every dollar you risk is a fighter in your personal financial regiment. When the battlefield conditions deteriorate, when the trend shows clear signs of exhaustion, a wise general doesn't sacrifice troops in a hopeless battle. Instead, they pull back, preserve strength, and prepare for the next favorable engagement. This perspective creates a fundamental shift in how you approach trading. Instead of focusing exclusively on the current opportunity, you maintain awareness that markets are cyclical. The next opportunity will always emerge, but only those who have preserved their capital will be positioned to capitalize on it. The heartbreaking pattern seen in most trading accounts is a cycle of winning, then giving it all back, leaving the trader depleted precisely when the most promising opportunities appear. Behind this principle lies a deeper revelation about market mastery. The greatest traders aren't distinguished by their ability to extract every possible point from a trend. Rather, their edge comes from knowing when to engage and, equally important, when to disengage. This selective participation, this willingness to step aside when conditions become unfavorable, represents the pinnacle of trading wisdom. The transformation happens when you internalize that stepping aside isn't failure. It's strategic preservation of resources for better opportunities. This mindset shift reframes the entire trading experience from a series of isolated battles into a sustained campaign where preservation of capital becomes as important as its growth. If this concept of treating your capital as precious soldiers in your financial army resonates with you, comment "protecting my troops" below. It's a powerful metaphor that can fundamentally change your relationship with risk. Another critical signal that appears as trends approach their conclusion is a marked increase in volatility. This phenomenon represents a fundamental transformation in market character that often goes unrecognized by the average investor. While a healthy trend displays relatively smooth, orderly movement with contained pullbacks, the end stage brings chaotic price action that tells a revealing story about the market's internal condition. You'll notice wider daily swings, whipsaw price action that traps both bulls and bears, and false breakouts that quickly reverse. This increased turbulence isn't random. It's the visible manifestation of a power struggle occurring beneath the surface. The steady directional conviction that previously drove the trend has been replaced by uncertainty and conflict. What makes this insight so valuable is its predictive quality. Increasing volatility isn't merely a coincidence, it's a reliable harbinger of change. The market is essentially revealing its indecision through these erratic movements. Where once there was clarity and consensus about direction, now there is debate and discord. This battleground creates the perfect environment for professionals to exit, while amateurs remain confused by the mixed signals. Wyckoff emphasized a principle that cuts against conventional wisdom. Trade only when the odds are heavily in your favor. During periods of heightened volatility, those favorable odds have disappeared. The certainty that previously supported your position has evaporated, leaving only gambling in its place. The wisdom lies in recognizing when conditions no longer support committed positions. This connects directly to a deeper concept Wyckoff called distribution, perhaps the most illuminating revelation about how professional operators actually work. Distribution represents the methodical, patient transfer of shares from strong hands to weak, from the informed to the uninformed. It's a behind-the-scenes process that unfolds right before our eyes, yet remains invisible to those who don't understand its mechanics. Picture how a major market campaign typically unfolds. A stock has been rising steadily for weeks or months. The professionals, having accumulated their positions early and quietly, have been rewarded as prices climbed. As the advance continues, media coverage turns increasingly positive. Analysts raise targets, news coverage expands, and public interest grows. By the time everyone is talking about the stock, when it appears on television, dominates financial websites, and enters everyday conversations, a profound but unseen shift has occurred. The professionals are no longer interested in buying. Their mindset has transformed completely. They're now focused exclusively on selling. The tragic irony is that this is precisely when the public's excitement reaches its peak. The uninformed crowd, finally convinced by the apparent strength and positive narrative, jumps in with both feet just as the smart money is heading for the exits. It's not a conspiracy, it's simply the natural cycle of how markets distribute risk from the patient to the impatient, from the disciplined to the emotional. What makes distribution so fascinating is that it happens in plain sight, disguised as strength. The public buys into apparent stability or even continued advances, completely unaware that they're purchasing from professionals who have already captured the easy profits and now seek to exit before the inevitable reversal. If you've ever found yourself buying into a stock that everyone was talking about only to watch it decline shortly after, type "I've been distributed to" in the comments. Acknowledging this pattern is the first step toward avoiding it in the future. The mechanics of how professionals actually execute their distribution strategy reveals a mastery of market psychology that few retail investors ever fully grasp. These experienced operators understand a fundamental market truth. They cannot simply dump millions of shares onto the market in a single transaction. Such an approach would immediately crash the price, destroying the very profit they seek to capture. Their challenge requires a more nuanced and patient approach. Instead, they implement a carefully orchestrated process, feeding stock to the public gradually while maintaining the illusion of market strength. This artful deception is what makes distribution so difficult for the average investor to detect. The market continues to display what appears to be bullish behavior. Prices hold near highs, occasional rallies emerge, headlines remain positive, yet beneath this facade, a profound transformation is occurring. If you examine the quality of these rallies closely, you'll notice subtle but critical changes. They may look impressive at first glance, generating excitement and drawing in new buyers, but they don't carry prices as far as previous advances did. The effort-to-result ratio has shifted dramatically. Volume remains large or even increases, creating the impression of healthy participation, but the actual progress becomes increasingly limited. This diminishing return on volume represents one of the clearest fingerprints of distribution in action. The revelation here is that what most interpret as strength is actually disguised weakness. The professionals are using each rally, each positive headline, each apparently stable period as an opportunity to unload their positions. They're not creating these moments of strength, they're exploiting them. This understanding provides a completely different lens through which to view market action. To truly master this concept, it helps to understand distribution's opposite process, accumulation. These two phases represent opposite ends of the same market journey, mirror images that reveal how smart money operates across complete market cycles. Accumulation happens after a decline, when strong hands quietly absorb shares from discouraged sellers. The public has given up, sentiment is negative, and professionals begin building positions without fanfare or attention. Distribution, conversely, happens after an advance, when those same strong hands unload shares to excited buyers who have finally been convinced of the opportunity. The emotional states of participants in these two phases couldn't be more different. Fear and disappointment during accumulation, excitement and optimism during distribution. Yet both phases serve the same purpose for professionals, transferring ownership at advantageous prices. The aftermath of these phases tells the complete story. After accumulation has run its course, stocks break upward with vigor and conviction, often surprising the public with their strength. After distribution completes, they break downward with violence, shocking those same investors who believed the narrative of continued strength. These dramatic moves aren't random. They're the natural conclusion of processes that were visible to those who understood what to look for. What makes this insight so valuable is that it shifts your focus from narratives to actual supply and demand dynamics. Stories can deceive, but the interaction between buying and selling pressure ultimately determines a price direction. By learning to recognize distribution patterns, you develop the ability to step aside before the inevitable breakdown occurs. If you've had that moment of clarity where suddenly distribution patterns became visible to you in a chart you were studying, write "I see the distribution" in the comments. It's that moment when the market's hidden mechanics suddenly become clear. The greatest insight Wyckoff offered to serious market students was this fundamental truth. The market is ultimately about money changing hands, not about stories. Distribution, at its core, represents the methodical transfer of ownership from informed, disciplined professionals to uninformed, emotional amateurs. The stories, headlines, and narratives that captivate the public are often just the backdrop against which this transfer occurs. This revelation creates a profound shift in perspective. Once you understand that market action is primarily about money flows rather than news events, you begin to see through the illusions that trap most participants. The tape, the actual record of transactions, tells the real story, while public narratives often serve merely as justification for what's already happening beneath the surface. The journey toward market mastery involves a conscious decision to follow the money rather than the stories. This path isn't always comfortable because it frequently puts you at odds with popular opinion. When you see distribution patterns forming while headlines remain positive, you face an internal conflict. Do you trust your analysis of money flow, or do you surrender to the comforting narrative? Many traders, even those with experience, ultimately choose to believe the story rather than follow the money. They find reassurance in bullish commentary, logical-sounding explanations, and consensus opinions. This preference for comforting stories over uncomfortable realities explains why the market always has a fresh supply of victims. The wisdom to separate narrative from reality represents perhaps the most valuable transformation in a trader's development. This understanding brings us to one of the most fascinating and deceptive moments in market psychology: the blow-off top. This phenomenon represents the ultimate trap, designed to capture the maximum number of unsuspecting participants at precisely the wrong moment. To untrained eyes, the blow-off appears to be the moment of greatest strength, as prices soar faster and further than at any previous point in the entire move. The emotional impact is nearly irresistible. After watching a stock climb steadily for months, suddenly it accelerates dramatically. The excitement becomes contagious, spreading through financial media, social circles, and investment communities. The narrative shifts from cautious optimism to absolute certainty. This time is different. We're entering a new paradigm. The old rules no longer apply. Yet behind this apparent strength lies a hidden truth that Wyckoff understood decades ago. The blow-off top isn't the beginning of something greater. It's the final bait before the market turns. It serves a specific purpose in the market's natural cycle, creating the perfect environment for professionals to complete their distribution. They need a frenzy of eager buyers to absorb their remaining inventory, and the blow-off provides exactly that: a crowd desperate to buy at any price. The psychology at work is fascinating. The very moment when caution should be at its highest is precisely when most investors abandon it completely. Fear of missing out overwhelms rational analysis. The desire to participate in what appears to be easy money clouds judgment. And in this emotional storm, the transfer of ownership from strong hands to weak reaches its crescendo. What makes this insight so powerful is that it allows you to step outside the emotional current that sweeps most participants along. When others see the blow-off as confirmation of endless opportunity, you recognize it as the final act in a predictable drama. This awareness doesn't just protect your capital, it positions you to benefit from the inevitable reversal that follows. If you've ever experienced that moment of clarity where you suddenly recognized a blow-off top forming in real time, write "I spotted the final trap" in the comments. That recognition represents a pivotal moment in any trader's journey. As we've explored these timeless principles that Wyckoff developed through decades of market experience, I hope you've gained insights that will transform your approach to spotting trend reversals. What separates the consistently profitable trader from the perpetual victim isn't just knowledge. It's the disciplined application of that knowledge in real market conditions. The patterns we've discussed today, diminishing volume, leadership deterioration, sentiment extremes, rhythmic changes, and distribution phases, these aren't just theoretical concepts. They're practical tools that have protected capital and preserved profits through countless market cycles. The market continues to leave these same footprints today, waiting for those patient enough to observe rather than predict. If you've found value in these insights, consider subscribing to the channel. I'm committed to sharing these time-tested market principles that most traders never fully grasp. Each video builds upon the last, creating a comprehensive framework for navigating the markets with confidence rather than hope. I'd love to know which of Wyckoff's concepts resonated most strongly with you. If something in this discussion clicked in a meaningful way, write Wyckoff Wisdom Unlocked in the comments below. Your perspective might help fellow traders connect dots they've been missing. If this approach to market analysis makes sense to you, hitting the like button lets me know to continue exploring these deeper market truths rather than the surface-level analysis you find elsewhere. There's a video right here that complements today's discussion, where we explore how to identify the beginning of these powerful trends before the crowd notices them. Click and continue with me there as we build on these foundational concepts to develop a complete market framework that puts you ahead of the emotional cycles that trap most participants.